The selling resumed last week as all 5 major markets ended lower. Emerging markets led the pack lower as the index lost 4.5% last week. The Nasdaq was not far behind it with a loss of 3.2%. The drop in the equity market was fueled in large part by the activity in bonds as yields rose higher. Fed Chairman Jerome Powell spoke on Wednesday, stating that despite the removal of the word accommodative from September's official Fed minutes, interest rates are still accommodative and that we may go past neutral, but we are a long way from neutral at this point, probably. Global bond markets took that comment and ran with it. The 10-year Treasury closed at 3.23% on Friday. This is the highest level that yields have been at since May of 2011. The impact spread to other segments of the bond market, as the Bloomberg Barclays U.S. Aggregate Bond Index fell another percentage point to close out the first week of the last quarter with a year-to-date loss of 2.5%. U.S. corporates were hit even harder as the AAA-rated U.S. corporates fell 1.7% to close out Friday with a year-to-date loss of 4.76%. Last week's economic news was dominated by the monthly employment data. The news cycle began with ADP reporting a substantial beat in their employment report as they showed an increase of 230,000 jobs. Expectations were for the report to show a 179,000 increase in jobs month over month. Thursday's new jobless claims fell, with a reading of only 207,000, well below the 213,000 estimate. Analysts were waiting to see the impact of Hurricane Florence, which had a minimal impact on the job market in the Carolinas. Friday's BLS employment situation report came in very differently, however. The monthly report missed expectations with an increase of 134,000 in non-farm payrolls compared to the 184,000 expected. The miss was attributed in large part to the impact of Hurricane Florence. This was something that we saw last year with the string of hurricanes that hit the South. However, the August data was revised upward substantially from 201,000 to 270,000. Additionally, the unemployment rate dropped from 3.9% to 3.7%. This is the lowest the unemployment rate has been at since the bell-bottom days of December 1969.